The Federal Reserve is basically providing a tremendous amount of facilities to make sure the credit markets continue to function. And this is the most important thing. Asset markets, the stock market is nothing. Credit market is everything. Credit is the lifeblood of the economy. Stock market doesn't matter one iota. If stock markets go up and down, it really doesn't matter because it's only about 10% of the economy anyway. But the rest of the economy runs on credit. So the credit markets are extremely important. And that's why the Fed is in such a panic now to make sure that they continue to function and operate. In our portfolio, we've been primarily focused on healthcare, technology, and staples. We've been out of discretionary for a long time. We've been out of emerging markets and basic materials and industrials and these areas that have been hardest hit by the virus, and focused on areas where there are opportunities. There are advantageous spots to be invested now. This is part of the work we do every day, which is try to find where to allocate money and where not to.
And I think one thing that makes this a little bit easier is we can use our personal experiences. We can say, okay, where am I spending money?
Over the last decade, we've been hailing 2% growth as being good, right? Wow, we were 2.3% growth. That's great, strong economy. 2% growth was previously noted as pre-recessionary. Of course, this is when we were growing at 6 or 8%. Being at 2% basically just keeps up with the level of population growth that you have in the economy. New people coming in, you're going to increase economic activity to absorb those new people. So 2% growth is simply just kind of absorbing all the new entrants into the economy. That's not strong economic growth. That's not the type of economic growth that creates wealth and prosperity across the broad stretch of the economy. For individuals that are looking to retire, we're hoping to retire, what's happening in the economy and markets now, for many baby boomers, the opportunity to retire is now permanently delayed for a variety of reasons, mostly bad advice from Wall Street and financial advisors around the world that have given, really poor advice over the course of time that have led to a tremendous amount of capital destruction.
We're seeing a lot of people, just because of bad plans, come back and say, whoa, we never anticipated such a downturn and so quickly. And I don't think really many people did. People are going to have to change, and not just because of what Wall Street has projected, but also what Wall Street says you must do, which is really interesting if you think about it, because a lot of banks are coming out with earnings and their trading departments are all through the roof.
Right. Oh, yeah.
But they're not trading for any clients.
Right, exactly. They're trading their own prop book. So a lot of people are coming to this realization. It's like, oh, wow, everything was fine. And then all of a sudden it's not. We were warning about a recessionary event for the last couple of years because the data was telling you that. When you look at the freight index, that freight index was already warning of economic weakness months ago. We were writing articles last summer warning about the yield curve inversion, and that the yield curve inversion typically forebodes a recessionary environment in the economy. And everybody's like, it's wrong this time. Well, it wasn't. These indicators were in place long before we got there. Economic weakness was already coming. There were plenty of warnings to start tailoring back your risk to markets and exposure. With Danny, we were working on reducing client exposure to portfolios back in January and February of this year because of these warnings were all in place. And it's like, well, nobody could have seen the virus coming. The virus was not the cause of what is happening in the economy. It was the trigger event that created the crisis of the magnitude that we're seeing. Now, for most Americans right now, the market is down more than 12% for the year. That wiped out 2 years worth of gains for most people. Goldman Sachs just announced earnings for what happened through January, February, and March. Their profits came in at $3.11 per share on $8.74 billion in revenue. Now, they do a lot of stuff, right? They have banking, they do other stuff. So what's important is that while everybody else in the world was losing money, they didn't. The trading revenue on fixed income was the best quarter in Goldman Sachs history ever. Goldman, JP Morgan, all these guys, they're the ones telling you, you just have to buy and hold. Here's the product I want to sell you so you can buy and hold. Here's my ETF I produce. Here's this product. Here's that product. Here's this. You buy it. You hold on to it. Please don't sell it because, you really can't manage market risk and volatility. You can't time it. You just hold on to this.
And don't worry about that. I'm going to charge you a management fee, and you're going to buy our product, which has an internal fee as well.
Bingo. But on the back end, they're trading like crazy. They're not holding anything, and now they're just basically buying stuff from the government and selling it off to the Federal Reserve. It's not illegal, but it's a rigged game. And it's a rigged game that you don't get to play. The markets do not work for you. They are not there to help you make money. They are there to sell you product that you are going to wind up paying for one way or the other. We ran out of eggs at our house, and my wife went online to buy eggs, and they were sold out at the store. So fortunately, we have a friend of ours. So we have a ranch house and up in a small town outside of that, and of course there's other ranches around. Anyway, my daughter has a friend who owns a ranch, and she went over to his ranch and got 4 dozen eggs yesterday from their chickens. So,
and they were huge.
They were huge, and they were blue.
Oh, yeah.
Blue eggs.
Yeah.
Which I don't know if the rumor has it that blue eggs are actually lower in cholesterol. So I don't know if that's actually true or not, but that's the story.
Higher in cobalt.
Nice.
Could be.
Nice. We don't have that option.
So,